If one investment pays a 6% dividend and another pays 2%, is the 6% one automatically better for building wealth? Not necessarily. The number that feels most like income can sometimes hide the number that matters most. This video is about dividend yield versus total return. In plain English, should you focus on the cash an investment sends you or the full change in your wealth over time? The tension is simple. Dividends feel real because they arrive as cash, but long-term wealth is built by everything that changes your account value. When you own a stock or a stock fund, there are usually two possible sources of return. The first is income, like dividends. The second is price growth, often called capital appreciation. Total return counts both. Dividend yield only looks at the income part, compared with the price you paid or the current price. Imagine you buy an investment for $100. Over a year, it pays you $3 in dividends, and the price rises to $107. Your dividend yield was 3%, but your total return was about 10% before taxes and fees, because you received $3 and also gained $7 in market value. Now, flip the example. An investment pays a $7 dividend, but its price falls from $100 to $93. The dividend yield looked attractive, but before taxes and fees, the total return was roughly zero. You got cash, but the account value gave back the same amount. A common mistake is treating dividends like interest from a savings account. A dividend is different. When a company pays a dividend, it is distributing part of the company's value to shareholders. All else equal, the stock price adjusts around the dividend date because cash has left the business. A useful mental model is moving money from one pocket to another. Before the dividend, part of your wealth is inside the company. After the dividend, part of it is in your brokerage account as cash. That movement can be useful, but by itself it does not magically create new wealth. Long-term wealth comes from what the underlying assets earn, how much of those earnings are reinvested, how well capital is used, and what price you paid. Dividends can be one way to share profits, but they are not the only way. A company can also reinvest in the business, reduce debt, or buy back shares. Dividend yield is emotionally powerful because it looks like a paycheck. If you see a 5% yield, it is tempting to think, this investment pays me 5%. But the market does not only care about the payment, it also cares whether the payment is sustainable and whether the asset itself is becoming more or less valuable. The total return lens asks a cleaner question. After counting dividends, price changes, taxes, fees, and reinvestment, did your purchasing power grow? That question is less exciting than chasing a high yield, but it is closer to how wealth actually accumulates over years and decades. This does not mean dividends are bad. For someone who needs regular cash flow, dividends can be convenient. They can also create discipline for investors who like seeing a business return cash. The point is not that dividends are useless. The point is that dividend yield alone is an incomplete scorecard. The big wealth-building question is what happens to the dividend after it arrives. If you spend it, that cash no longer compounds inside the portfolio. If you reinvest it, you buy more shares. Those shares can produce their own future dividends and can participate in future price growth. If this kind of calm money breakdown is useful, consider subscribing. The goal here is not to tell you what to buy. It is to make the trade-offs easier to see, so financial decisions feel less like slogans and more like clear comparisons. Two investors can own the same dividend fund and have very different outcomes. One spends every dividend, the other automatically reinvests them. Over long periods, the reinvesting investor owns more and more shares. The original yield may be the same, but the compounding path can be very different. This is why the right question depends on the job of the money. If the job is current income, cash payments may matter a lot. If the job is long-term accumulation, the bigger question is whether the portfolio's total value can grow after inflation, taxes, and costs. Some strong long-term investments pay little or no dividend because they reinvest heavily. That does not automatically make them worse. If reinvested earnings create value, the shareholder may benefit through a higher stock price instead of cash distributions. The wealth shows up in the market value, not in a quarterly payment. Dividends can also say something positive. A steady dividend can suggest that a mature company has real cash flow and a shareholder-friendly policy. But a signal is not a guarantee. A dividend can be maintained, raised, frozen, or cut depending on the business and the economy. A yield trap happens when a high dividend yield attracts investors, but the high yield is partly caused by a falling share price. If the market thinks the dividend may be cut, the price can drop before the cut happens. The yield looks bigger precisely because risk has grown. Dividend yield is usually calculated by dividing annual dividends by the share price. If a stock pays $5 per year and trades at $100, the yield is 5%. If the price falls to $50 while the dividend has not changed yet, the yield jumps to 10%. That higher yield might be an opportunity, or it might be a warning. The formula cannot tell you which one. You have to ask why the price fell, whether earnings support the payout, whether debt is manageable, and whether the business can keep generating cash. A dividend is only sustainable if the company has the resources to pay it. If a business pays out more cash than it can comfortably afford, the dividend may be funded by borrowing, selling assets, or weakening the company. That can protect the dividend for a while, but it may hurt future total return. This is where total return is helpful. It does not get distracted by the form of the return. Cash dividend, price increase, or reinvested distribution. Total return asks what happened to the whole pile of wealth. That makes it harder for a big payout to hide a shrinking investment. Taxes can also make two returns feel different. In many tax systems, dividends may create taxable income when they are paid, even if you reinvest them. Capital gains are often taxed when you sell. The exact rules depend on the country, account type, holding period, and the kind of dividend. In a taxable account, a dividend can create a tax bill before you actually want to spend the money. That reduces what is left to reinvest. A stock that grows in price without paying much income may allow more control over when gains are realized. This is not always better, but it is a real trade-off. Inside tax-advantaged accounts, the immediate tax effect of dividends may be different. That is why location matters. The same investment can behave differently depending on whether it sits in a taxable brokerage account, a retirement account, or another tax wrapper. The investment is only one part of the after-tax result. Fees are another reason total return matters. A fund with a high yield but high costs may leave less for the investor than a lower yield fund with better overall performance and lower expenses. The cash payment may be visible, while the fee drag is quieter. Many beginners assume higher yield means safer income. Sometimes the opposite is true. A very high yield can reflect stress, uncertainty, or a market expectation that the payout will not last. Safety comes from the strength of the underlying assets, not from the size of the percentage on the screen. A lower-yielding investment can build more wealth if it grows faster, reinvests capital well, avoids unnecessary taxes, and keeps costs low. A higher-yielding investment can still be useful if the income is sustainable and fits the investor's needs. The mistake is treating yield as the finish line. Think of a fruit tree. One tree gives you a basket of fruit every season, but the tree slowly weakens. Another gives fewer baskets now, but grows larger and healthier. If you only count today's fruit, you may miss which tree creates more value over time. Some investors dislike Syrah because it feels like eating the seed corn. But selling a small portion of a broadly diversified portfolio can be another way to create cash flow. Economically, receiving a dividend and selling a tiny slice both convert investment value into spendable cash. The difference is control. Dividends arrive on the company's schedule and in the company's amount. Selling shares happens on the investor's schedule, though it depends on market prices and personal discipline. Neither method is perfect. Both are ways of turning ownership into cash. For people living off a portfolio, predictable income can reduce anxiety and simplify budgeting. That psychological benefit matters. A strategy that someone can calmly stick with may be more useful than a mathematically elegant strategy they abandon. Still, the income plan should be judged by sustainability and total return, not yield alone. Chasing dividend yield can also narrow a portfolio. High-yield stocks often cluster in certain sectors or business types. That can leave an investor more exposed to one kind of economic risk than they realize. Diversification is not just owning many names. It is owning different sources of return and risk. Broad market funds often include companies with many payout policies. Some pay dividends, some buy back shares, and some reinvest for growth. The investor receives the combined result. This is one reason total return is such a useful measuring stick. It lets different business models be compared on one scoreboard. A dividend that stays flat may feel stable, but inflation can reduce its purchasing power. If prices rise over time, the same cash payment buys less. Long-term wealth is not only about the number of dollars received, it is about whether those dollars can maintain or increase what you can actually afford. This is why investors often think in terms of real return, meaning return after inflation. A portfolio can show positive income and still lose purchasing power if the asset value falls, taxes are high, or inflation runs ahead of growth. Total return is the starting point. Real after-tax return is even closer to lived reality. Instead of asking only, what is the yield, ask a wider set of questions. What is the total return over meaningful periods? How volatile was the path? Are the payouts supported by cash flows? Are taxes and fees reasonable? Does the strategy match the job you need the money to do? Dividend investing and total return investing are not enemies. Dividends are one component of total return. The problem begins when the component gets mistaken for the whole machine. A high yield can be useful, risky, sustainable, temporary, or misleading. You only know by looking at the full picture. The simplest takeaway is this. Dividend yield tells you how much cash an investment is paying relative to its price. Total return tells you what happened to your wealth overall. If your goal is long-term wealth, the second question is usually the more complete one. So when you see a high dividend yield, pause before calling it a bargain. Ask what the business is worth, whether the payout can last, what taxes and fees will do, and how the whole portfolio is growing. If you have a question about dividends, total return, or a related money topic, leave it in the comments for a future video.